So let's switch gears here and talk about growth. Now, we know that developments have played a big role in RioCan's growth over the years. How should we think about development completions and spending over the last few years? And as a related question, how have the slowing housing markets informed your view on whether you're going to do more in condo or rental?
We've set an objective with respect to developments, and that objective was spending somewhere around $400 to $450 million annually on new developments. We feel that this was supposed to be an objective that was durable, that was supposed to withstand any kind of economic backdrop. Most of our developments are mixed use, so a lot of residential goes into those developments. There's always going to be a retail component that marries with the residential. We think it's a great combination of uses. And we still feel that no matter what the backdrop, it is important. It's an important aspect of our growth story. It's one that differentiates us, and it's one that we can afford to do. We've set our balance sheet up in a way that we don't have to raise equity in order to fund this level of commitment to developments. And while there is some short-term drag, there's long-term benefits. And actually 2022 marks the first year where we've seen the real results of that commitment to development many years ago. We have more development deliveries than we do spend, meaning that we've created value of around, call it $700 million in 2022 relative to a spend of $400 million. And that's taken us a long time to get to. And it's that delivery of that $700 million of value that will really enhance our growth prospects. So while there's a lot of sacrifice involved in development, we're now seeing the fruits of that labor. With respect to the second aspect of your question about the mix between multi-res rental and condo, we look at everything. First of all, I think there is a housing crisis in Canada, particularly where we build and on transit. So
shortage of housing,
absolutely. And I think that will inform a lot of our decisions, because even though the current dynamics might not be ideal with heightened interest rates and inflation hitting a lot of the costs that go into building some of these mixed-use developments, the long-term value of those is I think remarkably robust, and I think we're going to see a lot of that play out over the next little while. And so, but to the specific question, the balance between rental and condo, we look at every project on a singular basis, and oftentimes we have enough density where we build more than one building. So we'll have 2 towers, 3 towers, whatever it might be. We look at the market absorption that's logical in that area. We build as much multi-res as we think can be absorbed, and then the rest will typically be condo. The condo will typically help us pay for the multi-res. And in this environment where everything slows, we look at everything through an IRR lens. And if we know that the condo simply won't sell or won't be successful, that probably means that the IRR hurdle will not be met, and we'll just pause on that development until the conditions are appropriate for us to go forward. And just finalizing that and closing the loop on it. For RioCan, where we've got active and very functional shopping centers on these development sites, it doesn't hurt us to wait. So that's what we're doing now.
Interesting, and that's pretty much describes the current environment where there's maybe a bit of a pause and kind of see how things shake out. Is that fair to say?
Yeah, not on every project, because some still do cross that hurdle from an IRR perspective.
Right.